Demand for mortgages has fallen 10% in just the last week. Further, it is 12% lower than what they were at 1 year earlier. This begs the question, is the real estate bubble finally over? Is it popping? Is this lack of demand going to drive prices down, especially as interest rates go up? And are we about to see a collapse in the real estate market? Ready? Let's dive in. All right, guys, so the big story happening right now is about interest rates. And in anticipation of the Federal Reserve raising the Fed funds rate, we're seeing interest rates across the curve start to go up. Now, that includes mortgage interest rates. Mortgage interest rates have been increasing over the last couple of weeks as well. So that's the first reason. It's interest rates are going up in anticipation of the Fed funds rate going up. But the second reason is because of the loss of purchasing power on debt if the interest rate is below the inflation rate. Now, for a long time now, lenders have been okay with lending at interest rates that are below the current rate of inflation because they expect that in the future, the inflation rate will drop back down. So overall, lenders think they'll still make money. Now, I've been saying for a long time, and many other people have been saying for a long time, don't be a lender. And if you're a saver, you're also a lender. If you have a pension or a 401k, you're most likely a lender. But if you are a lender and you have income that is less than inflation, the interest rate on the debt is less than the inflation rate, you're losing purchasing power. So as the risk of inflation persisting longer than initially anticipated by the industry, as that risk increases, we are seeing higher and higher interest rates as lenders are saying, we don't want to get screwed. We're going to raise interest rates because there's a higher chance now that the inflation persists, and borrowers have been getting the long end of the stick. They've been getting rewarded here by borrowing money, and then when they have to pay it back, they're paying it back with dollars that are worth less than what they originally borrowed, because dollars are easier to get your hands on today than they were 3 years ago. And so borrowers have been getting the good end of the stick, and now lenders are saying we want to increase interest rates because we don't want to be getting the short end. We don't want to be losing here. So as interest rates have been going up, especially mortgage rates, that has been pushing pressure on mortgages, obviously, right? Because if mortgages get more expensive, all things being equal, supply and demand is going to say there's going to be less people looking for mortgages. So what are the numbers here? In 1 week, mortgage applications to purchase a new home dropped by 10%, and that number is 12% lower than what it was at 1 year earlier. Now, normally, if mortgage rates go up, you're going to see house prices decline to compensate, and so the housing affordability for a new buyer is going to stay exactly the same, because let's say somebody can afford $2,000 for their mortgage, doesn't really matter how much of that goes to principal and interest, how much of that the home price is high versus mortgage rates are low, that person's still going to be able to afford $2,000 either way. So if mortgage rates increase, the house they will be able to afford will decrease. So usually that's what you see happen in the market. Housing prices drop when mortgage rates go up, and vice versa. Over the last couple of years, mortgage rates dropped, so housing prices went up. People are spending the same or a little bit more on their mortgages. But in contrast to what would normally happen, we saw the average loan size hit another record high of $446,000. So despite the cost of mortgages going up and the interest portion of that going up, we've still seen an increase in the cost of houses, meaning that not only is the interest part of the mortgage going up, but also the principal as the house cost goes up as well. So across the board, we're seeing the cost of getting into a new house is growing, both on the house price and on the mortgage cost. Now, part of the reason driving this is because inventory was down yet again. This is probably the biggest driver going on right now is inventory. The total inventory for homes for sale was down 28% nationally in January of 2022 from January of 2021. New listings were also down 9%. This is a massive drop in inventory, which makes sense, right? Because so many homeowners over the last 2 years refinanced. They were able to lock in crazy low mortgages at record low interest rates. They got a big bump in their monthly income from getting that cost of their house to go lower. A lot of people were able to do cash out refinances as well because the equity in their house grew. And so nobody that did that wants to move now that housing costs have gone up from mortgage costs increasing. And so the number of people selling their homes right now, if this trend continues with mortgage rates, is only going to go down. Nobody's going to want to increase their mortgage payment to buy a house that's the exact same quality or potentially even worse. So anybody who bought a home or refinanced over the last couple of years, for the most part, is not going to be selling. They are locked in and they're going to keep it no matter what happens, unless things go the other way and get much cheaper. As you might expect, refinances fell because of this. The applications to refinance a home fell 7% week over week, and they were 52% lower than 1 year ago. Obviously, because you're not going to want to refinance your mortgage if the cost is going to increase. And so people were refinancing a lot when mortgage rates were a lot lower than they'd ever been. And now that they're going back up, pretty much everyone has already refinanced. And again, this is driving home prices higher and higher, with less and less people selling and still the same or more people still needing to buy. And you might be asking, if nobody's selling, who's buying? Well, we basically had, this is something that's very much ignored by many people analyzing the real estate market around the country. We had almost an entire generation that was locked out of the housing market for a long time. Millennials. In 2010, millennials had an opportunity to start picking up houses for very cheap and become investors, and we've seen a lot of popularity on social media and on different platforms from people who got rich because they were able to buy houses at the exact right time in history, and they got very rich as a result. But they are the exception, not the rule. For the most part, millennials looked at that and said, we're terrified. This just wiped out the wealth of our parents or our grandparents, so they stayed away from buying houses. Well, turns out 10 years later, the exact same story is still going on, as a lot of these millennials finally got into a job, got into a workspace, got into a position where they were able to start affording more and more. Now they're at a point where they're saying housing prices are the same or worse than they were before the crash when I was a kid, so there's no way I'm going to buy right now. I'm going to rent until the crash. There's an entire generation going on like that right now, which is meaning that all of these people are renting right now. Rents for professionally managed apartments actually went up 10% in just the third quarter last year alone. The national average for rent went up 4.8% in a single month from December of 21 to January of 22 last month. And this highlights what I've been saying for 2 years now. It's a supply and demand issue. There are more people that need a place to live than there are places to live right now. This is not the same as it was 12 years ago when houses were empty. There were way more houses than there were people to live in them. If housing prices were going up but rents were plummeting, that'd be a different story. There are plenty of houses for people to live in, right? That's not what's going on right now. A huge portion of our population cannot afford to buy a house right now, so they're renting, and rent costs are skyrocketing because still there are not enough places to live. Supply and demand. Rents are skyrocketing. And that's spreading to not just the low end of the income curve, especially among millennials. It just hit a record high on the high income earners who are still renting. Those making more than $75,000 a year are driving nearly 70% of total renter household growth. And in 2021, 39% of all rental applications came from individuals earning more than $50,000 a year, which is a record. And if you see the demographics chart here of millennials in the black, Gen X, pink, and boomers, blue, this is the number of Americans who have reached the peak age for first-time home buyers. It is at a record high right now for millennials. Again, supply and demand. There was a giant gap in home building, and even right now, as construction is trying to get ramping up, they just cannot keep pace with, number one, catching up to the last 10 years, and number two, catching up to what's going on right now, and number three, catching up with the prices and the supply chain issues. There's too much going on right now. We are years away from making up that gap in construction to get enough homes built to put some sort of a dent in supply and demand, some sort of a dent in inventory. Home builders are facing rising costs right now now for land, labor, and lumber, and it's becoming harder to make a profit at the lower end, and so they have to build houses that they can sell at a profit, which are going to be the more expensive ones. Now, that might look like a bad sign to you, especially when we look at the fact that more homes than ever now are selling for $50 million or more. In 2013, you only had one home sold total above the $50 million mark. In 2015, again, only one home total above the $50 million mark. And in 2021, 42 properties sold for over $50 million. And 2020 was a big year, but 2021, it was 35% more. And the fact of the matter is that in a housing crash, at the end of a bubble, what you typically see is the most expensive ones show it first. The high end shows it first. We're not seeing a slump at the place where you'd see it first yet. Now, because of all of this, skyrocketing home prices, increasing mortgage costs from interest rates going up, and decreasing income relative to inflation, we are seeing sentiment for home buyers at basically an all-time low. The number of Americans who think it's a good time to buy a home hits an all-time low. The number of Americans who think it's a good time to sell is, on the flip side, very, very high right now. This is what's called a contrarian indicator. You don't see this during a bubble. During a bubble, you see euphoria and everybody piling in, thinking they're going to get rich. It's the exact opposite what we're seeing right now. And finally, let's take a look at this chart from the Federal Reserve, the monthly supply of houses in the United States. So this chart shows if there were no new homes coming onto the market, how long would it take at the current rate of selling for all of the homes that are for sale right now to get sold? So you can see this long-term average. We are nowhere near some of these bubbles that we've hit during prior peaks, during prior recessions. We are very much on track with the trend that we've had for just the last, 7 or 8 years. Has it been increasing over the long term? Yes. Are we seeing anything out of the ordinary? Not yet. Further, I'd like to highlight here, I've drawn a circle around every single time there's been a recession since 1960 on this chart. You can see that the supply of houses spikes during recessions. That makes sense, right? If you can't afford things because you lose your job, you lose some income, you're going to try and sell your home, fewer people are going to be able to buy the homes, you're going to see the supply increase. However, look what happened in 2000. Was there a little spike? Yes. Was there anything like before or even the next recession? Absolutely not. Why is this? Well, because that recession was primarily driven by the dot-com bubble burst, in which the Greenspan put came into play, interest rates went down, and that shoved a bunch of money into real estate. And so we didn't see that spike there. Now, we made up for it, obviously, during the financial crisis, but fast forward to 2020. During that recession, did we see a little bit of a spike? Yes, we did. It's very similar to the dot-com bubble burst spike. It was nowhere near other recessions. Why is that? Well, what did the Federal Reserve and the government do to deal with that recession? They bailed out the entire economy. There's precedence for this now. You lower interest rates. You push down mortgage rates. You do forbearance, and you let people not pay their mortgage. You give people stimulus checks. And mark my words, the next crash, we're going to see all of that plus a lot more. And if we have everything change right now. Let's say what I was been talking about supply. New home building takes off. Supply chain issues perfectly worked out. Construction takes off. We start to see, let's say, a huge demographic of old people start to die. Number one, what we are going to see is that will help millennials and new home buyers get into the market. There is a massive demographic right now that has not purchased, that is waiting for an opportune time to purchase, and that's basically just affordability. Is the mortgage going to be cheaper than renting? I'll buy. That's it. It's not looking for investment opportunities, not looking to time the market, not looking for everything to crash down to get rich. There's a huge portion of Americans right now that all they're doing is waiting for, if I buy a house, will it be cheaper than renting? And if we see a massive supply increase, all of those people are going to buy. So we'll see a dip in rents, and we're going to see an increase in soaking up that extra supply. Number two, if we see a foreclosure wave, we are months out from that. That will happen. That takes a lot of time, and minimum 6 months before we start to see foreclosures skyrocket, if that happens, which is a big if, because there's so much equity in homes across America right now. But let's say it happens. Well, guess what? That's 6 months away. What's going on throughout that time? Interest rates are going up. It's getting harder and harder for businesses to service their debt. It's getting harder and harder for governments to service their debt. Somebody falls over, a recession starts, a crash starts. It takes so long for real estate to respond that by the time we start to see an impact on home prices from an increase in supply, from foreclosures and things like that, it is far more likely that we see other crises start to pop up across the economy that the Federal Reserve and the government will have to step in to deal with. And what happened last time they stepped in to deal with these crises? They have to push down rates. What does that do to housing? Makes it a lot more affordable, pushes prices up. And they will sacrifice the dollar on the back of rescuing the economy. And every single time in history, when a government decides to sacrifice the currency to rescue the economy, they basically sacrifice both, and the price of everything, including real assets like land and real estate, go through the roof. And so, as I've been saying for over 2 years now, there is nothing that I see data-wise that is pointing me to believe that there's any sort of crash coming in real estate at all. I will definitely let you know if something comes up that changes my mind, but all the data points that are coming up right now point to just the basic supply and demand, the basic cost of living, the cost of buying a home, the cost of renting, points to there's no end in sight for housing prices going up. And if we see a lull or if we see a drop, there's so many buyers ready to come into the market that it will not result in any significant decrease on average across the nation, and will at worst result in a slowdown before the next crisis results in another economic-wide bailout from the Fed and the government. If you'd like my recommended resources on getting started investing in real estate, I've got affiliate links in the description below, and I will be in Dallas on March 5th. I would love to see you there. I'm speaking at an event. If you'd like more information, a sign-up link is in the description below. As always, really appreciate you guys. Thanks so much for watching. Have a great day.